Welcome everyone to Vested Interest. This is Shane back for Stock Pick of the Day video. It is almost the end of July. We're going to be quickly moving into August here. One more day left in the trading month. So if you have any stocks you wanted to buy in July and haven't got to them yet, make sure you get them tomorrow because that's the end of July and on to August we go. We are going to be taking a look at one out of the healthcare sector today, Merck. Let's jump in. And before we get too far into the video, if you could do me a favor and hit that thumbs up button down below if you are a dividend growth investor and you find any value in the content. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Make sure you ring that notification bell so you're notified whenever we put out any new content. I do put out the stock pick of the day videos Monday through Thursday whenever the market's open. I do viewer and subscriber suggestions as well. So make sure that notification bell is click so that you can tune back in whenever we release out any videos that you may recommend. And if you do have a recommendation of a company you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down in the comment section below. Doing all that really does help a small YouTube channel like mine with the YouTube algorithm. It helps to spread the videos a little bit longer, a little bit further out. And one more thing you can do is watch a little bit longer. Make sure you're watching the entire videos or at least a little bit longer than you normally do, because watch time is another metric that the YouTube algorithm uses to see which videos you all like out there and which ones to push out to more people. So appreciate the subscribers out there. The channel continues to grow because of people like you. Over 1,000 subscribers now and on to 5,000 and beyond we go. Now this is the Vested Interest Stock Screener. This is a screener I use to look at thousands of companies out there in the stock market and see if I am interested in doing more of a deep dive into the financials of the company. It's just a quick screener. Again, thousands of companies to kind of weed through to figure out which ones you even want to look at. And then if it meets 5 of 8 or 6 of 9, if it's a financial company or a bank or an insurance company, then I do more of a deep dive into financials and I look at stuff like price to book, PEG ratios, free cash flow, percentage yield. I look at stuff like, is the revenue growing? Are their margins expanding? Do they have more assets than liabilities? Are their margins expanding? Are they paying down debt over time? Are they buying back shares, or are they diluting me as a shareholder? A lot of other good information in the balance sheet and income statements you should be looking at if you are investing in individual companies. And if you do not want to do that type of deep dive, then I would stick to index funds or ETFs. Something that tracks the S&P 500 is what Warren Buffett would recommend. So something like VOO, which is the Vanguard S&P 500, or SPY, that tracks the S&P 500, or there are other companies out there, ETFs. Just jump into Google or Ask Jeeves or Bing or whichever search engine you want to use and type in S&P 500 index funds or S&P 500 ETFs, and you'll find a lot of different ones out there that you can jump into. Schwab has some, like I said, Vanguard VOO is a real popular one. Now let's jump back into the video here. Now, if you want to know more about this company, check them out at www.merk.com. That's www.merck.com. That is their homepage where I pulled this information from. We're a global healthcare company working to deliver innovative health solutions through our medicines, vaccines, biological therapies, and animal health products. We're focused on discovering new solutions for today and the future. And you can see here this old-timey truck all the way back in 1891. Merck & Company, founded by George Merck, age 23, established the company to distribute fine chemicals throughout New York City and the neighboring areas. And that must be one of his first trucks, if not the first one that he did his sales out of, right? That's an old-timey truck, 1891. Can you believe they were driving around back then? Now we're pushing for, electric cars and flying cars and all kinds of craziness. So it's been a long time. They've been around well over 100 years. And I think as long as we have an aging population, and as most of us get older, all of us get older, we're going to need more pharmaceuticals to keep us in the shape that we want to be, to live the lives that we want to live. So companies like this, Pfizer, Johnson & Johnson, several others, aren't going anywhere. It's just a matter of, are they a good company to be buying now? And to find that out, let's take a look a bit more into the company. We're talking about Merck & Company, ticker MRK, out of the healthcare sector. Huge drop on the day, 9.81% drop on the day. That's why we're looking at them, down to $115.25. I did do the math before I jumped on the video. Their 52-week range is $99.14 with a high or a low of $99.14 with a high of $134.63. Even with the big drop on the day, they are just out of 15% of their 52-week low. They need to be around 114 or lower. market cap of 291.906 billion. So this is a large cap company, a beta of 0.39. So typically they're much less volatile than the overall market. Though 9% on the day, that's a big drop for any company. That's a big drop for a year, let alone a day. Now this is where things get a little wonky here. Price to earnings ratio, PE ratio, extremely elevated, $129.49 per share. That is not in line with anything that you should be buying. Even fast-growing tech companies, I start to get worried anytime they get over 40, 50, unrealistic expectations on some of the growth with some of these companies, and I get it. People are buying them still, the Teslas of the world. But this is not realistic growth for a company well over 100 years old. Price to earnings is very elevated here, and that might be part of the reason for the big drop. EPS, earnings per share, is 0.89, so 89 cents per share. Earnings date was today. They actually had good earnings from what I saw. I did look at it a little bit before the video, but you want to check it out for yourself. I thought the earnings actually looked pretty good, but huge drop. So I'm thinking that it's just because the overall price per share is a little elevated right now. Forward dividend is $3.08. They are quarterly payers, so divide by 4, though we'll see that here in a little bit towards the end of the video, what they pay per share per quarter. Nice starting dividend yield, 2.4%. Excuse me, 2.41%. Ex-dividend date coming up September 16th. They will pay out October 7th. Excuse me. Now we're going to jump over and look at dividend yield theory to see if this one is presenting any value. To do that, we take a look at their 5-year dividend yield average of 2.88%. We compare that to their current 2.41, or over here where it says forward 2.41, same number. And since it is lower than their 5-year average, that speaks to overvaluation. Now, payout ratio, extremely elevated. I would really be concerned. They are either taking out debt, they are either issuing more shares, maybe they have cash on hand, but their payout ratio right now is 333.33%. Very, very elevated. This company, if that lasted for more than a couple quarters, would definitely be in danger of a dividend cut. Again, unless they have a significant amount of cash on hand or they are diluting you as a shareholder to make up the difference. That's a really, really elevated payout ratio. Let's jump down to free cash flow, see how their free cash flow is growing. As a dividend growth investor, I want free cash flow growth because typically if a company has growing free cash flow growth, one, their payout ratio won't get crazy out of control unless they're increasing their dividends faster than they should be. And two, they typically increase their dividend payout ratios as well as buy back shares, pay down debt, make acquisitions, as long as their free cash flow is growing. 2020 here you can see 5.8 billion. 2021 jump up to 9.6. 2022 jump up to 14.7. Looks good so far. And then here's where the trouble begins. 2023 dropped down to 9.1 billion from that 14.7. So it looks a little bit cyclical, and it's actually 2023 might be a little bit lower than even 2021 numbers. So I would not give them growing free cash flow. A big spike up in 2022 with a huge drop back down in 2023. They are sporadically repurchasing shares. They did in 2020. They did in 2021. Why they didn't in 2022, I don't know. They had a very good year there. Maybe they thought the stock was too elevated. And then they did again in 2023, 1.3 billion. But that does not make up for the drop from 2022 free cash flow numbers. Now, the previous page we saw stockanalysis.com, or I'm sorry, we saw Yahoo Finance. This is stockanalysis.com. I like to go to 2 or more sources for information to make sure the information I am getting is accurate and up to date. I recommend you do the same. Now, stockanalysis.com has 11 analysts take a look at this. They call it a consensus buy. If you were to go to their homepage, you'd be able to click on how many might call it a strong sell, a hold, a buy, or a strong buy. But the majority are either calling it a strong buy, or a hold, with the overall consensus of a buy. They do have a low estimate of $104. That would be a 9.76% decrease from where they currently sit. They have an average estimate of $135.36, which would be a 17.45% increase, and a high estimate of $155, which would be a 34.49% increase. All the while, you could collect that 2.4% dividend yield, at least if you were to buy them now. We're going to jump over to statistics, see how well this company is reinvesting its capital back into itself. To do that, we look at return on equity and return on invested capital. I like 10% or better for these metrics. It does not meet that. Return on equity is sitting at 5.8%, lower than what I'm looking for. Return on invested capital actually is very, very low at 3.37%, not what I'm looking for at all. Now, EPS growth, I like forecasted at 5% or better. Theirs is smoking high. Never seen anyone company have EPS forecasted this high, 146.04%. If that's true, that's very, very good, but I don't know how much I trust that. We'll see. Revenue growth is forecasted at 5.98%. Now, onto their dividend yield or dividend history to kind of wrap this one up. Quarterly payout ratio, again, very, very elevated, 342.22%, way too high for my liking. Dividend growth is at 5.48%. I don't know that they should be growing their dividend if their payout ratio is so elevated. They do have 14 years of growth, buyback yield of 0.27%, shareholder yield of 0.84%. They do pay out on the January, April, July, October timeframe, so I do like that payout timeframe is a little offset from a lot of other companies. Going back to March 2022, they were paying 69 cents. They raised it up December 2022 to 73 cents. Raised it up again December 2023 to 77 cents. I would anticipate that their next dividend raise, if they're going to continue raising it, would be coming in December of this year. But boy, with such a high payout ratio, they should be paying down debt, continuing to buy back shares, and doing some other things. But right now, that payout ratio is very, very high, and I would be worried about a dividend cut on this one. So let's jump back to the screener and see how they stack up. We started with understanding the business. Check there. Did not have growing free cash flow from 2022 to 2023. There was a bit of a drop down, and actually 2023 numbers were a little bit lower than 2021 numbers. So no check there. Growing dividend. They do have a growing dividend, though I am worried is that going to continue for very much longer with such a high payout ratio. Dividend payout ratio of 75% or less? No, definitely not. Check valuation based on dividend yield theory. Dividend yield theory says it's potentially overvalued. It is not quite at 15% of a 52-week low, so no check there. Even if you got that one, it wouldn't be enough. ROIC, ROE does not meet the 10% I'm looking for. Return on earnings per share growth does, well over 100%, but I don't know if that's realistic. Overall, 1, 2, 3, and like I said, even if it drops a little bit lower to 15% of a 52-week low, that would only give them 4. It does not meet my criteria to even make it on my watch list. I will not be doing more of a deep dive into this one. It needs to pull back significantly. It needs to get its free cash flow in order, and I'd like to see more in terms of return on invested capital and return on equity. So not very good. Looking for Merk right now. Let me know what you think of it. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Merk you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it in the comment section down below. And let me know what you think of Merk. I like the company, don't like the valuation, don't like the return on equity and return on invested capital, where that's sitting, and really do not like how elevated the payout ratio, the free cash flow, and the payout ratio is, and the big drop in free cash flow from 2022 to 2023. Let me know what you think in the comment section down below. Love to hear from you. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.